Hi, this is Mehmet Altın. Welcome to Chapter 2, Strategic Pricing video. We discussed the business's purpose and some flaws associated with profit or return on investment approaches in the first chapter. We also learned how barter works and how transactions works best when both buyers and sellers find value in them. Finally, we argued that revenue management should be customer-centric and strategic approach. You should use strategic approach, not tactical approach. As we proceed through this chapter, we will examine the concept of price from both buyers and sellers' perspective. We will also examine why revenue managers who decide prices focusing on supply and demand or cost make poor decisions. Last but not least, we will discuss strategic pricing in general. Now, effective pricing ensures that your prices are in line with your customers' willingness to pay, which we discussed in the previous chapter. Like the firm and customers both gain value from this optimized approach. But that's the important part, right? Both customers and firm gain value. The first step toward doing this effectively, however, is to understand the price itself. To put it simply, price refers to the amount a buyer pays for a product or a service in the hospitality industry. Now, it is important to remember that in the hospitality industry, other firms are used instead of price, such as a room rate. An economist defines price as the cost at which something is obtained. An accountant, on the other hand, defines price as the amount of money something would bring if or when it is sold. Similarly, hospitality professionals define price as the value placed by a firm on its product and services, or price is the amount of money charged for a good or service. While each of these definitions has its merits, successful revenue managers must also recognize that each one has its limitations. Now, it is important to realize, considering the discussion from chapter 1, that both the buyer and the seller are part of the definition, right? Both buyer and seller are part of the definition. Prices can be used as nouns or verbs, but the idea of value given up remains the same. Like, for example, in the noun approach, the amount of value given up exchanged by the buyers and the sellers in a business transaction. We can say, for example, the cost of the room, for example, is $199 per night, right? If we use as a verb, we can say that to determine the value for which a buyer and seller will exchange, give up, we need to meet, just to give an example, we need to meet with revenue managers to price New Year's Eve dinner, okay? Don't forget, this definition do not mention cost, profit, return on investment, or supply and demand. Once again, I will be repeating this multiple times probably, but bear in mind that while we are not advocating for ignoring the cost, profit, return on investment, or supply and demand, you still need those. What we are saying is you need to understand to their shortfalls and recognizing that effective and strategic pricing is more than just a calculation. Okay, then what is price? First, I want you to consider the example in the book, I believe it's on page 30, where revenue manager needs to quote a price for 100 people. If you didn't read it, please just go in there and read that section and come back. Now, when we want to quote the price for 100 people, the simplistic approach is required using appropriate formulas or calculation, which you should always use them anyway. I mean, once again, I'm repeating myself sometime, but we are not saying that You should only focus on the customer. Don't worry about the cost, return on investment calculations, formulas. You should use them anyway. However, what we are trying to say is effective revenue manager should also address the following question in addition to your calculations. This is also in the page 30, but let's talk a little bit about it. Like, for example, will our price today influence the decision of this group buyer to buy from us in the future? Right? Because they might think about whatever you're pricing today it might affect their relationship with you for in the future. We may have to refuse individual booking requests for the same night if the group accepts this price, because we're gonna sold, if it's 100 room, we're gonna sold 100 rooms, and those rooms not gonna be available for individual bookings. If that happens, how will that impact the number of reservation requests for the same night? Is the price based on the type of room that the group wants? Does the price take into account whatever this group is likely to cancel at the last minute, no shows, arrive early, stay more than one night? Do you think that this price is influenced by what our competitors might quote the same group? I mean, most likely this group is gonna not just approach you, right? Most likely they're gonna approach your competitors as well. If this group accepts our price, what secondary sources of revenue might they generate? Like, this is an important part, right? Food and beverage sales, meeting room rentals, etc. Possibility of non-room revenues. Think about the Las Vegas. I mean, comparatively, the similar level hotels, they are usually cheaper because they expect people to come and spend in casinos and still make money. Is there a historical relationship between the hotel and this group? Other groups of the same type? Like, relationship important because you should always consider the lifetime value of customers or groups. Is the quoted price influenced by the type of payment to be used by the guests? What is the estimated timelines of the group's payment? In what ways has the source or channel from which the business originated influenced the recommended price? You can see that there are many questions we are talking right now that math alone or calculations alone cannot answer. So it is important that your price reflects these concerns as well. And it could be many more questions depending on the situation. But the idea is here, you cannot just focus on the math and ignore other aspects, other non-math related external factors. Now, let us try to understand the price from the seller's and buyer's perspective. We will start with a seller. There are different ways that sellers can set their prices. We are going to talk about in this approach following the book two-tier pricing. If you haven't so far, please stop the video and read why do restaurants charge their customers so much for wine at dinner, part on page 31, and come back here. Now, assuming you read that section, in the end, that example is about successful restaurant owners who realize some diners are buying valuable enhancement for their dining experience. They are not there to simply drink wine. If the idea was just drinking wine, they could have paid 1/3 or less of the price from the liquor store and drink at home. They are there to enjoy an experience, which is why they find value in it, even with inflated prices. At the same time, many guests don't want wine, but just want to enjoy a good meal. We should recognize that different customers have different expectations. That's the important part, right? Different customers have different expectations. And different amounts should be charged to them as long as they see value in the transaction. We're going to focus on the future chapters in this as well, and the differential pricing. Similar to the restaurant example, two-tier pricing is used in many industries. For example, airlines charge money for the ticket, but add baggage or seat selection charges. It helps people who don't have a baggage or don't care about their seat selection. They pay relatively less. By the way, before continue, I am not really a fan of this a la carte approach, but just the sake of argument, we're gonna continue on this. Others, on the other hand, might have a luggage or want to select their seats and don't mind paying extra for seat they desire, as long as they see value in those additional fees. Once again, value always comes up. If it is one price, they all pay same amount, regardless of whatever you have a luggage or not. In two-tier pricing, one sees value in lowered price, assumably of course, due to no luggage or seat selection. The other might see value in extra choices that they can make. Once again, the buyer must see a value in the transaction. Otherwise, it could backfire. Now, we first need to understand that buyers make purchases based on genuine belief that the transaction will benefit them. Furthermore, we need to understand consumer rationality, in which buyers consistently behave reasonably and purposefully. Having said that, the book also contains many examples of irrational behavior, right? And marketing research tries to understand how buyers perceive value and their behavior. What is the significance of this? The key to being a successful manager is to realize no matter how you price a product or service, it will only work if customers see the value in it. A product's value is equal to its perceived value minus its price. I'll give you a simple example. You always buy a large pizza for $15, and your perceived value of that pizza is higher than $15. Otherwise, you won't buy it. This week, you noticed that Pizza Shop lowered the price to $12. Due to change in price, the value of pizza has increased, even though your perceived value was unchanged. Overall, the perception of value refers to perspective or opinion of customers towards a product or service, which is often influenced by how the product or service meets the customer's expectation and needs. When compared to other products or services, perceived value is how a customer evaluates or rates a product or services. Let's look at this table for a second. If your perceived benefits is minus price creates a value less than zero, which basically saying that price is higher than your perceived benefit, you shouldn't buy it. If the perceived benefits equal to price, usually do not buy most cases. I mean, there are certain things you might buy, so there are certain cases you don't buy, because we always want a little bit more. We want more perceived benefit than the price offers. And of course, in the last one is the perceived benefit is price minus price is if it's higher than zero, you definitely buy. I want you to focus on this. As a future managers, you have two options. You can change prices to change value, or you can use marketing methods such as bundles, branding, and marketing to change customers' perception of value. The most important thing is ensuring they understand what they are getting and why your offer is valuable. Repeating some earlier conversation, exchange happens when both parties find value in the transaction. In the next chapter, we will discuss value in more detail. Now, we have learned so far that price plays a vital role in buyer-seller transaction. Next, we will discuss other aspects of the marketing effort discussed in the textbook, following the textbook. The book talks about that they refer as a 4 P's of marketing. Just to let you know that in addition to 4 P's, there are also more detailed 7 P's of marketing, but following the book, we will focus on the 4 P's in this chapter. First, there is a product, but basically the point we are trying to make here is, as a future managers, you have to understand this aspect so you can do better decisions, right? First, there is a product. It is basically what you sell, a product or service that is available to customers and meets their needs. Here are some questions you should always ask. You should always ask, what makes your product unique? Are there any advantages to your product that make it stand out from the competition? Features and benefits, brand name, quality, safety, packaging, service, and warranty are some of the components, for example. Promotion includes all promotional strategies and advertising that can answer the question, why do customers need it? Is your product solving a problem they have so they can purchase it? They have some kind of problem, your product. I mean, like, I'm going somewhere, I need to stay, right? For example, as a very basic, but additionally, where and how can your target audience be reached and communicated with? Advertising, personal selling, sales promotion, public relations, and direct marketing are all included. The place is where you should sell your product. It is all about location, location, location when it comes to hospitality. In addition to physical location, however, it also encompasses food service units, lodging properties, distribution channels, and inventory management. Of course, the most important factor is the price. We already talked about that. Although sellers determine prices, if there is nobody to purchase the product or at those prices, they are meaningless. That's the important part, right? We determine the price, but if nobody's gonna purchase that product at that prices, basically, if you are targeting the wrong segment, they don't mean anything. Among the components of pricing are the pricing strategy, the room rates, the menu prices, the discount, allowances, credit terms, and payment terms. It is also important to understand supply and demand, cost approaches, and flows associated with them in order to price effectively. Now, you are introduced to the idea of supply and demand in economics courses. The law of supply states that the higher the demand for a product, the more it will be produced by the seller. Moreover, the law of demand says that the higher the price of a product, the less demand there will be for the product. The price is determined by the intersection of supply and demand curves. The graph shows that if demand changes, price and quantity will change, or if the price changes, demand will change. A supply and demand curve could explain certain economic conditions, but it may not be as helpful for revenue managers when trying to determine prices. First of all, supply in hospitality industry is relatively easy to measure, such as how many rooms there are in the hotel, how many tables there are at restaurants, how many seats there are on airplanes. However, in order to measure hospitality product demand, three factors must be taken into account. Right? It starts with desire, which means people need or want the product you are offering. However, that alone is not enough. I mean, many people prefer to stay in luxury resorts or eat at fine dining restaurants. A second condition is that they should be able to pay, which means they should have a financial capacity to do so. Last but not least, are they willing to pay for your product? Furthermore, demand could be affected not only by price changes but also many external factors. Secondly, the equilibrium price does not determine a product's value. I mean, do you recall the first chapter? Value is determined by buyers and their perceptions. Moreover, in the hospitality industry, when supply increases, say a new hotel built in your area, might increase the overall demand actually, instead of decreasing prices according to supply and demand. Prices might increase as a result of an increase in visitors. We've seen this many times, right? When you build, more people come. It's always possible. So that is some of the flows on supply and demand. Let's talk about a little bit about the cost. Costs are the expenses incurred to obtain the items necessary to operate a business. Fixed costs, like for example, rent or mortgage, are expenses that you pay regardless of how much business you have. right? I mean, you cannot just say, hey, we have a less customers, we are not going to pay this month's mortgage. A variable cost, such as the cost of ingredients in food, changes based on the volume of business. You can check out this chapter for more detailed list, giving the many different examples there. But it is vital to understand that your revenue must exceed your expenses or costs in order for your business to survive. First of all, I want you to be sure about that. You can use the break-even points to determine how much sales you need to make before making a profit. That is the point a firm's revenue exactly equals to its expenses or costs. In the graph, total costs are represented by the y-axis and sales volume are represented by the x-axis. You might notice that the total cost line starts higher than zero. Why? Because there are fixed costs, which means, once again, you still have to pay even if your sales are zero. You cannot tell your landlord, if you are renting, or mortgage company, if you own the property, that we do not have any sales, so I will not be paying this month. You can also watch the video following this in chapter 2, apply what you know video, if you would like to see an interactive example of this break-even analysis. Now, it is true that profit can only be assured if you make more revenue than your cost. That's nobody argue with that. In this case, it will be a wise idea to use cost when establishing your prices, right? An approach like this is known as cost-based pricing. In theory, assuming you know your costs, then you would add some profit and have the selling price. Basically, I'm just making an assumption here. You know your product costs $5 and you want to make $2 profit, then your price is going to be $7, right? As far as this approach is concerned, there are some issues. First, it is challenging, if possible at all, to determine the exact cost in the hospitality businesses due to significant fixed costs. Unit costs in the hospitality industry change with volume. Right? We have a industry with the significant fixed cost, like hotel building, for example. You have to build hotels, cost a lot of money to pay rent, mortgage, etc. We'll assume you estimated the price using this approach. Let's make an assumption that you decide to use this method. If demand is weak, cost-based pricing results in higher prices. And as you recall from the earlier slide, your customers may not be willing to pay them because when there is a demand is weak, you add a lot of fixed cost into your cost and your price is going to go up, and demand is already weak, right? So if there is a strong demand on the other hand, cost-based pricing could be lower than people are willing to pay, and you can leave some profit on the table. A second flaw of cost-based pricing is that businesses increase their product or service prices when costs increase. It is important to remember from earlier discussions that people won't purchase a product unless they see the perceived value increases. I mean, can you explain to your customers why your cost increase matters? I mean, think about it. Have you, like, when you order, let's say, hotel room, do you sit down and consider, I wonder about their cost? You just want to get a good price. That's all. I mean, their cost really is not related to you. And I don't think even if they explain to you, it's going to matter to you. Another fatal flaw of cost-based pricing is that it focuses on the internal aspect of the business rather than on the customers or guests. The focus of our hospitality business is and should always be on the customer. Furthermore, focusing on cost efficiency instead of business effectiveness to reduce the impact of cost-based pricing on customers may also lead to lower quality. It could be detrimental to the business if customers feel that their perceived value has decreased due to poor quality. So these are some of the issues. First thing we need to recognize is that buyers' perception of price are more important than sellers. It is important to remember that we have sophisticated customers who have many options and access to information. I mean, think about it. Even when you look at for products in the internet, like even in the restaurants or hotels, they have many options and they have an access, and they are very smart, and they understand they can. I don't want to say they want to play the system, but they can also play the system. So you need to understand them. You need to understand their perception, their sides. Prices need to be applied strategically, which means managers should utilize the latest data and insights to match prices with buyers' perception of value. We need to understand that prices send signals. For example, buy signals to buyers, assuming price matches with their value. They are able and willing to pay. And sell signals to sellers if they perceive they can optimize their profit for a given price. So prices overall encourages businesses to be cost efficient so they can produce their goods at the lowest price. Further, prices ensure that scarce resources are rationed to the buyers who value them most. Once again, the key word here is the value. Thank you for watching.